Our publisher Lakshaman Bandaranayake recently sat down with Kris Canekeratne, Chairman and the Chief Executive Officer of Virtusa Corporation, a NASDAQ-listed global information technology services company providing IT consulting, technology and outsourcing services, to talk about the recent acquisition of Polaris by Virtusa, engaging millennial digital natives and digital disruption in financial services and life sciences. Welcome to LBO Fireside Chat Series with Kris Canekeratne. Part 1. Virtusa Corporation acquires Polaris Consulting and Services.
I started Virtusa back as one of the co-founders back in 1996, and we have seen very strong progress since then. As a matter of fact, we just concluded our 32nd quarter of sequential quarter-over-quarter growth. So we basically met or beaten our guidance to the street for the last 32 consecutive quarters, and every quarter has been an up quarter. Virtusa has made very strong progress. Our growth over the last 10 years or 6 years has been north of 23% on average per year, which is approximately twice that of our industry. We've put ourselves into a very strong position of strength, both in terms of our balance sheet, our capital structure, our market capitalization, as a company that will do on a non-acquired basis, just purely from a Virtusa organic standpoint. This year will be a year where we do approximately $588 million to the midpoint of our guidance. And if you take a look at the last 6 years, we've basically grown at 23.7% CAGR. We have over $204 million of cash on our balance sheet. We clearly have strong market capitalization. Our market capitalization post announcing the acquisition is over $1.6 billion US. As a leadership team, we have performed at a level in our industry that has been very, very significant and very much at the top echelon of the space. We are basically acquiring approximately 53% from the promoter founder and from another promoter as in Orbitech and some minority shareholders, and that 53% will essentially cost us $180 million. Then, pursuant to the Indian regulation, we are going to be offering an open market tender offer for an additional $90 million. That will take us to up to 74.99% of the outstanding share capital of Polaris. So the initial $270 million assumes that we exercise that entire open market tender offer and get to an overall position of 74.99%. At that point, the Indian regulations basically cut you off, and they basically put you into a cooling off period, and you cannot go into the market for some period of time after that. In general, acquisitions are risky endeavors. There is no ands, ifs or buts about that, and there are successes or not across every segment of acquisitions. The reason for doing this is because we believe that it greatly strengthens our platform, and after carefully analyzing the risk profile, we feel that because the acquisition is so complementary, that there are fewer channel conflicts, which is what typically creates acquisitions to go bad from a go-to-market standpoint. And given that the synergies are so strong, we feel that we can actually expand our position overall in banking and financial services. What makes this particular acquisition for Virtusa very synergistic, however, is the complementary nature of what we do. So let me give you a little bit of context around that, Lakshaman. So Virtusa, a company of $588 million in revenue for this fiscal year, has approximately our single largest industry segment happens to be banking and financial services and insurance. In the case of Polaris Consulting and Services, they are exclusively a services provider in banking and financial services. Now, what's interesting and why this is strategically so compelling to us is that Virtusa focuses on an aspect of banking and financial services that includes consumer banking, that includes compliance and risk operations, includes some elements of investment banking. Polaris Consulting and Services have extensive capabilities in corporate banking, trade finance, transaction processing, and some expertise in consumer and investment banking. Market standpoint, we are going to combine the Virtusa banking and financial services together with Polaris's banking and financial services and go to market as one autonomous Virtusa Polaris global financial services go to market. One of the biggest issues that you typically have is channel conflict. In other words, most large acquisitions, the same account is controlled by both sides of the acquisition. One of the synergies that's driving this acquisition is actually revenue synergies as opposed to cost synergies. We've already identified over $100 million of revenue synergy over a 3-year period just by being able to cross-sell Virtusa services to Polaris clients and Polaris services to Virtusa clients, and we haven't even included the fact that we can now go after larger engagements, that we can actually win more accounts beyond the accounts that we currently have. We expect that the rapid growth of Virtusa will be rejuvenating for the entire global banking and financial services practice, just offset a little bit by the Citigroup headwinds, but across the board, the account base generates such a strong selling opportunity for us that we believe in relatively short order that we'll be able to get beyond the risks that I have outlined and actually get to a point of executing and hopefully resuming the industry-leading growth that we have seen. There are 3 significant benefits that's actually driving the strategic reasons as to why we are doing this acquisition. The first is because it's so complementary. It enables us to provide end-to-end services in banking. Second reason then is that it enables us to expand our addressable market. Right? In the past, Virtusa could address a part of the market, Polaris could address another part of the market. So now we can address a greater market. And the third is by virtue of being a company, if you just simply take Virtusa's revenue for this year and Polaris's revenue, that's 588 plus 310, which is just a little bit shy of $900 million. Now we have the ability to go after much larger outsourcing contracts, just given that we have more revenue under management and very large relationships in the specific instance of Citigroup, where our partnership is north of $100 million a year. If we were looking at this from a short-term perspective, a tactical perspective, probably would not have made sense to do this acquisition. But if you look at it from a longer-term perspective, the fact that as a result of this combination, we can expand our addressable market, we can provide more end-to-end services, and we can pursue larger deals, it actually is a very offensive strategy. By doing the acquisition, we basically are really creating a bigger, broader platform for the future.
You were listening to Kris Canekeratne, Chairman and the Chief Executive Officer of Virtusa Corporation, a NASDAQ-listed global information technology services company providing IT consulting, technology and outsourcing services. Kris was in conversation with Lakshaman Bandaranayake, publisher of Lanka Business Online. Stay tuned to LBO, Kris will soon be speaking about engaging millennial digital natives and digital disruption in financial services and life sciences. Thank you for watching LBO Fireside Chat with Kris Canekeratne.